Yo, what's going on, everyone? It's your boy TraqFX back with another YouTube video. In today's YouTube video, we're going to cover the topic of liquidity. And not only are we going to cover the topic of liquidity, but I'm also going to break down a signal which I sent out to the Discord community so that all of my traders, my students, were able to capitalize off of a setup. Now, we're going to go over the review of it, the confirmations behind it, the main reasons why I did what I did. And right now, we're just going to do a full top-down analysis to what led me to taking the trade. So without further ado, let's get right into this video. Now, when I approached the markets, I was on the 4-hour time frame, and I currently saw that the market was in a weird, awkward position because we did sell off, and there was what we seem to say is a break of structure, and overall everything just lined up to sell, right? Everything made sense that we'd essentially just be selling the market. But the first mistake that I saw in this overall picture was that I had no idea whether or not price would have respected the supply zone. So a huge mistake a lot of us traders can make is we tend to predict what will happen instead of reacting off of where price is currently trading at. So right now, all I see is that price is over here and we have two breaks of structures. So we have a break of structure over here and we have a break of structure over here. So then the first question that must be asked is, how do we differentiate from two breaks of structures on the opposite ends of the market? We have one break of structure that's going down, which tells us that the market is bearish, and then we have one break of structure which is going up, and that tells us that the market is overall moving bullish. So to understand this concept of multi-breaks of structures, we first have to understand the concept of liquidity. Now, as I've mentioned in my previous videos, every single higher high and every single higher low holds a certain amount of liquidity. Now that means that if every single higher high and higher low has liquidity, there is a chance that the market could break below the higher low to grab the money and then reverse in the opposite direction. So generally, when we see a break of structure such as this one right over here, we tend to jump to the conclusion that the market is not on a bearish trend. And that's something that I myself used to believe as well. But the truth behind this is that it's completely false, and that's a fallacy. The way forex markets work is just timed and priced around liquidity. So if the markets see that the market has a lot of liquidity over here, or to make this very simple, we see that Johnny and his 10 friends are holding $10 million worth of positions at this point, and the market sees that Johnny and his 10 friends are all buying exactly over here, and then Johnny and his 10 friends tell his 10 friends, and it's a full loop of just people telling each other and telling each other, to the point where all these positions become known to the fish. Sorry, not the fish, but to the shark. Now, the shark in this analogy would be the big banks, the people that are controlling the markets. So what they do is they see how much money has been piled and stacked around this area. And of course, the markets are priced and magneted towards liquidity. So they see this money and they sell off price. So they price in some sell positions in order for the market to fall all the way down to take out the money, which resides just below this point. And after that point is liquidated, meaning price breaks past a previous point, or this low right over here, that's when the market will reverse and continue with its bullish uptrend. So now the question comes, well, I thought this is a break of structure, so why didn't price respect this and then go down like that? So the main reason is because it's simply because over here there wasn't any reason for the market to sell. It made more sense for price action to buy up than sell down, and the only reason we really sold off was because there was a certain amount of money which resided at this point over here. And you're going to notice that this is a reoccurring theme which goes around in the markets many times, and eventually you'll become known to this specific pattern and you'll be able to trade this without any confusion. So in this case, when we see a huge break of structure down like this, we first must ask ourselves, is this a break of structure or is this a liquidity grab? Now, after you jump to the conclusion or you figure out whether it was a BOS or a liquidity grab, that's when it starts making sense that in reality, price action was simply grabbing liquidity at this point, and that there's liquidity at this point as well, so price was just simply grabbing liquidity. So there's two scenarios that could play out. Because we know every single lower high and every single higher low has liquidity, we could also say that this lower high over here holds a certain amount of liquidity as well. And there is a possibility of price action just grabbing money, whatever sell positions that were stacked up just into this area. After price action breaks above it, there is this high probability that the market could just completely sell off. And if we make our way to the Discord channel just over here, and we go to our Discord to the Euro USD trading setups, we can see that this is exactly what I had sent out. So right over here, I said that there's the possible scenario is we have liquidity resting above this high, and that liquidity is currently being grabbed. So there is a small chance that the market could completely sell off without reaching our supply zone. We're gonna get into why I chose the supply zone in a bit. So as you can see, this was scenario number one. Now let's go to why I actually believe this. So like I said before, or just a couple of minutes ago, every single lower high has liquidity. So if price action breaks above a lower high, we should not assume right away that this was a break of structure and price was simply just too bullish and now we're gonna go up like this, right? That's the wrong approach to take. The reason this is wrong is just because we don't have enough information to really come to a conclusion like that. Instead, what I did is I asked myself this: okay, if price action is bullish enough, or sorry, rather, it's bearish enough to just completely sell off because it grabbed money, then I'll see on the lower time frame that structure is shifting, and after London session opens, I'll look for a trade entry. But instead, what actually happened is we made our way to the 15 minute, and what I saw on the 15 minute was that we had so much liquidity being generated all around this area over here. So if we move our attention just to right before price action broke above our lower high, so this line is going to represent the supply zone. So we can see that there is a supply zone right over here where many traders were selling, and then right over here, the one that I've highlighted, let's say in red, give me a second, boom, this point is where price action just broke above the supply zone. So I'm going to delete this, and I want you all to focus on the black line. So we saw that as soon as price action broke above this supply zone, we saw that it was broken with a lot of momentum. But although it was broken, the structure stayed bullish. We still did not manage to change the structural trend. The overall trend was still in an uptrend. So because the overall trend was still bullish, we knew that the market was not bearish quite yet. And on the contrary, what we actually did see was that the market created so much liquidity over here. So this is what's called trendline liquidity. We can see that the market was creating a lot of trendline liquidity. And trendline liquidity, for those who aren't aware of it, those who don't know, is essentially just another trading pattern in which the market tests a trend line multiple times. And every time it's tested, traders assume that that trend line will be respected, and we simply just buy every time it's tested. And this works on the opposite end of it as well. So if you're a trader who likes to take sells, this is called a dynamic resistance. So when the market tests it once, it tests it twice, and the third time you just keep selling and selling and selling until the trend line is no longer respected. So in this case, we've seen that retailers were quite high in volume in around these areas. Now, something very interesting was that retailers were getting involved as soon as we broke above this point of interest, above this area of supply. So that means retailers were getting involved just above the point of break. That's a huge confirmation that we should be patient. Because if retailers are getting greedy, that means that we should be patient. And when retailers are fearful, that's when you jump into the market and make your move. So in this case, I knew that it was time to be patient simply because I saw the trendline liquidity. And on the other side, we also saw that the resistance side had been grabbed, but it was the bullish side, the buyers, who had not been liquidated yet. So essentially what my analysis was is we would wait for price action to make its way back down into this wick, which is an imbalance wick or a demand zone wick, whatever you want to call it, and we'd be buying at this point. Now, before I jump into the showing you guys the Discord, I want to take a brief moment to explain why I chose this point of interest instead of, another point of interest lower. So the reason I chose this point of interest is simply because this is the only point of interest which had imbalance, which had a very strong institutional candle, and it was also the last pullback, or it was the last bearish down candle before the move up that caused this major break over here. So for me personally, I said if there's liquidity resting over here, that means that the liquidity will be towards my area. That means if the market comes into my point of interest or it reaches that POI, traders would be getting stopped out whilst I would be getting in, right? So once again, to put this into perspective, if Johnny buys here and his 10 friends buy here, 9 out of 10 times their stop losses are just going to be 8 to 10 pips or something random. It's always usually a 1 to 1 or a 1 to 2 or something like that. And what happens is they set their stop losses here, not realizing that there's an institutional candle. And this institutional candle is like a magnet to price. Price needs to come back down to mitigate that POI. Why? Simply because there's imbalance over here, and imbalance is simply just a gap in the market which needs to be filled. And then number two, we also have the liquidity confirmation, which is all of the stop losses are gathered inside of our POI. So now we have multiple confirmations. We have one right? Which is that liquidity is gathered inside of a point of interest. And then number 2 is that we have imbalance. And then number 3 is that we have this point of interest. But to summarize it up, main reason we chose this POI is because this was the only POI that had imbalance, and it was the only POI which was just below the liquidity. So if we make our way to the Discord now, you guys can see that this is exactly what I had sent out to the group chat, minus all of the, trend line liquidity and that stuff, because I like to keep my charts clean. But the overall consensus was that we wanted price action to fall into this demand zone, and after confirmation, we would buy at this point of interest. If we go and make our way to what I had said, so I said on the 4-hour time frame, you can see liquidity was just recently grabbed. I was referring towards this analysis right over here. And then and price action has not yet mitigated the supply zone. So the supply zone which I was referring to was actually founded on the daily time frame, and the supply zone that I used was just this supply zone over here. So many of you were probably wondering why I chose this supply zone. It's simply because if we go to the 12-hour, we can see that the 12-hour has a very clean picture of the supply zone, which was not really clean on the daily. But a major tip that I have for a lot of you traders is if you ever see a candle with a long wick, remember that you should mark up that wick, simply because that wick is most likely a supply or demand zone on the smaller time frames. And we also have to take in consideration of the fact that this wick is so long simply because of the high amount of sell pressure. Because essentially the way candlesticks work are price action bull, the buyers were strong enough to bring the market up to this point, up to 109298. But because sellers were much more stronger, they brought the market all the way back down to where it closed at 108312. Now you also have to ask yourself, okay, if sellers were strong, why were they strong? And in this case, this is where you must look towards the left, and you must figure out whether there was something causing the strength of the sellers. And in this case, we saw that there was another supply zone just on the smaller time frames on the 12-hour that was founded right here, and price action entered that 12-hour supply, and then it pushed down. Now I can make my way down to the 1-hour once again, and now you guys overall understand why we had this supply zone marked up and why we wanted the market to reach it. Now what I actually did is I refined the 12-hour zone to this 4-hour point of interest right over here, and we had marked up this 4-hour POI just as you guys can see right over here. On the 8-hour, it's perceived a bit differently, but nonetheless it's quite the same. So we saw this 8-hour point of interest, we marked it up, and this was my overall target for buys. Now the reason I was bullish, the reason my bias was bullish, was simply because we hadn't yet mitigated this level of supply yet. And you guys can actually see we had about 14 pips worth of a gap between the opening and the closure. So we had a gap there that needed to be filled, and supply, like I mentioned in my previous videos, is like magnets for the market. Price just moves off of supply to demand, and then demand to supply, and in the middle of it, it grabs liquidity, because that's how the market maker are profitable and lucrative. So I have my overall bias. Now I'm gonna bring this topic back to what I said in the beginning. In the beginning of this video, I said that bias and momentum are two completely different things, and I'll provide you a very beautiful example to explain that. In this case, we can see that my overall bias is bullish. So I know that the market has to go up, or that rather my perspective is that the market should go up, simply because we have yet to mitigate the supply zone. But that doesn't necessarily mean that I could buy the market at the current price with no technical analysis, with no confirmation. Because if I were to do that, you guys can see that the market would have stopped me out, and it wouldn't have been a profitable setup. So instead, we have to remember that momentum and bias are two completely different things, and rather we have to time our trade to when momentum is in consensus with our bias. So yeah, that means basically meaning that if my bias is bullish, but the momentum of the market is currently bearish, I do not take the trade. But if my bias is bullish and the momentum of the market is also bullish, that's confirmation for me to take a trade, of course with technical analysis. We don't just buy because the market's going up. So in this case, my technical analysis confirmations were simply that the market was creating liquidity just below my POI. And then of course we waited for London session to open up before we executed the trade. Asia session, mainly it grabbed a little bit of liquidity just over here. After we grabbed that money, Asia session was completely bearish from there, and we sold off until Frankfurt finally entered the POI. Now I'm not going to go into the entry confirmations for this setup, but I can show you guys briefly where we entered, or where the entry would have been. The entry was somewhere around here, and take profit was of course just the supply zone, or you could just target the Asia session high depending on what you prefer. So this was the overall trade idea for London session on Wednesday. Now, if we play this out, you guys can see that it was absolutely beautiful. The trade just completely took off, hitting take profit in less than, let's see, in about 3 hours and 15 minutes. 3 hours and 15 minutes for a 7-to-1 is very, very beautiful. Now, along the way, there was also a re-entry, which was provided after a liquidity grab confirmation that we personally teach in the Discord. So we saw that there was a demand zone over here, which was disrespected. Many traders were actually using this demand zone to catch a setup. And if we use and go back down to the smaller time frame to actually analyze what took place or what price action did inside of this demand, we can simply see that it was nothing but manipulation. Why? Well, if you take a look at what the market did after it entered this demand zone, we saw that structure was broken. And usually what we're taught and what we're told is that after structure is broken, after the market reaches a point of interest, we simply just look for the institutional candle at the very bottom, which caused this move up. But if we take a look at what happens next, you can see, yes, the market does approach the POI. It respects it. And not only does it respect it, but it shows you strong confidence that the market is looking to go up. But if we play a couple more candles, you can see that it was clearly just manipulation of liquidity. Now, after we saw that liquidity was grabbed, this is where traders would have gotten involved. At least my students in the Discord, this is where they would have gotten involved after lower time frame confirmation. So maybe they would have possibly entered somewhere at this point, possibly somewhere like right over here with the stop loss, maybe just below this point, and our take profit being just the next high. So that would have been a 10-to-1. And something very interesting and key, which I want you guys to understand, is that notice how after liquidity is grabbed, price action generally moves very quickly. So there's little time where price is in drawdown. There's a very short period of time where price is in drawdown, and that's simply because after the market makes its move, meaning the move of grabbing liquidity, price will simply shoot towards the next point of interest which it's attracted towards. So in this case, we had our supply zone, which was just over here. Boom, and as you guys can see, we end up hitting it, and take profit was completely smashed. And not only did I catch this myself, or not only did the analysis was sent, but it was also sent to the Discord community for all of the traders in the group chat to get to capitalize off of this. So as you guys can see, I provided a full breakdown from the daily time frame all the way to the scenarios. I already mentioned the scenario. So scenario 1 was of course the demand buy zone, and then scenario number 2 was of course the that the market would just grab this liquidity and sell off. But I made sure that we sent this to the Discord community, and many traders did catch this, which was absolutely amazing. There's not a single better feeling in this world than making money with your own family and friends. So it's very important. So if you do want to get involved in the Discord, I recommend you to click the link in my bio, and then you guys can learn exactly how I trade these markets. So with that being said, thank you all so much for coming and watching the full video. If you managed to stick to the end of this video, leave a like, comment, and if you have any questions or concerns, follow me on Instagram and message me at TraqFX. But with that being said, I'll see you all in the next one. Peace out. Salute.